Let's talk about it. You've probably been hearing a lot of buzz about a new tax law for seniors, one that promises a massive break on Social Security. But what's really going on behind the headlines? We're going to separate the fact from the fiction right now.
So, here's the million-dollar question on everyone's mind. Is Social Security about to become completely tax-free? You've seen the headlines, I'm sure. The idea that federal taxes on your benefits could just disappear. It sounds almost too good to be true. And, well, that's because the real story is a little more complicated.
Right, no tax on Social Security. That's the catchy phrase that's grabbing everyone's attention. And look, it's an incredibly exciting promise, especially if you're a retiree on a fixed income. But while it makes for a fantastic slogan, the actual law doesn't just wave a magic wand and wipe the tax away. The secret is understanding how it really gets the job done.
Okay, so let's peel back the layers and get to the real story. The law, which has the very grand title of the One Big Beautiful Bill Act, doesn't actually get rid of the tax. Instead, what it does is introduce a totally different, and for many, a very powerful way of lowering that tax bill for older Americans.
And here it is. This is the absolute core of the whole thing. It is not tax elimination. What it is a brand new, much larger standard deduction created specifically for people who are 65 and older. That is the key. For a lot of folks, the end result might feel the same, but the way we get there is through a deduction, not by eliminating the tax itself.
Now, just a quick refresher so we're all on the same page. What in the world is a standard deduction? Well, think of it like this. It's a specific amount of money that the government basically says, hey, don't worry, you don't have to pay any tax on this part of your income. You just subtract that amount from your total income, which makes your taxable income smaller, and boom, you pay less in tax. It's as simple as that.
And this is where you can really see just how big of a deal this is. Before, seniors got the regular standard deduction plus a little extra for being over 65. But under this new law, that deduction just skyrockets. We're talking $23,750 for single filers and a whopping $46,700 for married couples who file together. That is a pretty significant increase.
Okay, numbers on a screen are one thing, but what does this actually mean for your wallet? For a real person trying to pay their bills? Let's run the numbers with a real-world example to see what kind of savings we're actually talking about here.
So let's take the case of a single woman. She's over 65. Her income for the year comes from a $30,000 pension, $10,000 from some investments, and $24,000 in Social Security. Now, under the new law, she gets to take that new, much bigger standard deduction and subtract it right from her income. This just drastically lowers the amount of money that's actually subject to tax.
And here's the bottom line. For this one person, the new deduction could mean a potential federal tax savings of around $720 for the year. And for a lot of retirees, that is a meaningful amount of money to have back in your pocket.
But, and this is a really important but, this new benefit is not for every single senior. The law was designed to be targeted, which means there are income limits. So the next logical question is, who really stands to gain the most from this?
Really, this law is laser-focused on helping retirees with lower and more modest incomes. For that group, the impact is, well, it's huge. In fact, this new deduction is so big that for some people, it could completely wipe out their federal income tax bill. So for them, that whole no tax promise effectively comes true, even if it's through a different door.
And this table shows you exactly how it's targeted. The benefit starts to get smaller, it begins to phase out for single folks who earn more than $75,000 a year. And it disappears completely once their income hits $175,000. For married couples filing jointly, you just double those numbers. So yeah, this is definitely not a tax break for high-income retirees.
So, we've got a tax cut for current seniors. But like with so many things in life, there's a trade-off. There is a catch, and this one has to do with the long-term health and stability of the Social Security system itself.
So here's that trade-off, laid bare. Actuaries estimate that this new tax deduction is actually going to speed up how quickly the Social Security Trust Fund runs out of its reserves. The projection is that the fund will now be depleted about 6 months sooner than we previously thought. So this tax break for today's retirees comes at a very real cost to the system's long-term stability.
This timeline helps put all the key dates into perspective. So, the law was passed in mid-2025, and it applies to that tax year. Seniors are going to see the impact when they do their taxes in early 2026. And when we look further down the road, that new, faster depletion date for the Social Security Trust Fund is now estimated to be early 2034.
And all of this leaves us with one final central question. The law provides tangible, immediate financial help for millions of seniors, particularly those who need it most. But it also shortens the financial runway for the Social Security system that future generations are going to depend on. It's the perfect example of the tough choices facing lawmakers, and now you understand the whole policy behind the headlines.